Hi guys, and welcome to this tutorial, which is gonna touch up on advanced supply and demand concept. This tutorial is a follow-up for those that didn't manage to attend the class on Wednesday. So for most of my students that were not able to attend, you're gonna have to listen carefully and try to understand what I'll be explaining. I'll try to have another session in regards to this topic here, because it's quite a bit of a long topic, but be that as it may, we just have to continue with our series regarding institutional supply and demand. So today we're going to be talking about advanced concepts that will give you an edge when you're trading using institutional supply and demand. On every asset that we trade, on every forex pair, on every commodity, we have what we call supply and demand imbalances. These are levels on our charts, and it's these that we are going to start with, and these are the levels that you should be able to trade from, levels that should give you an edge when you are trading using institutional supply and demand. So today we are going to be talking about zones. We're going to cover up fresh and original zones in relation to supply and demand. We are going to talk about dealer spikes. Some they call it stop hand. We are going to talk about liquidity. How is liquidity engineered in the market? We are going to talk about liquidity pools, as in areas where liquidity is likely to be at. We are also going to discuss a concept that I have come up with, and this is in regard to trading the high or the low of a supply and demand range. Then finally, I'm going to cover up a bit on trade configurations, because most people, they always ask me what time frame to trade from. So I'm going to cover up a bit of that on the trade configuration part. So let's continue. So firstly, we're going to talk about fresh and original zones. Supply and demand zones can be defined as follows. Number one, we've got what we call fresh zones, or basically new zones. This is a zone where price has not pulled back or retraced to yet, meaning the level has not been tested yet. I'll illustrate that as we go forward on the chart. Then we've got what we call a non-fresh zone. This is a zone where price has pulled back into at least once. Then we've got a used up zone. This is a zone whereby price has pulled back to quite a few times. This zone will no longer be a good zone to trade from, because if it's a supply zone, it means the more the times it has been tested, the more the sellers have been absorbed. Vice versa for demand. Then we've got an original zone. This is a zone that has been created out of nowhere and does not have any reference whatsoever to any previous zones. Then we've got an original and a fresh zone. This zone is the same as original, but it's still fresh, meaning it hasn't been tested. So make sure when you read this, understand perfectly. Most of you now know what is supply and demand. How do we identify supply and demand on the chart? So this is basically like a more explanation of defining, okay, I've managed to identify a supply zone. What is that supply zone in relation to where it is? Is it a fresh zone? Is it a non-fresh? Is it a used up zone? Or is it an original zone? You see? So you should be in a position now to identify that. So now let me illustrate a bit more of the original level and the fresh level. So how then do we identify an original level? Now on the illustration to your left, look left on the chart to identify original levels. So you must always look to the left of your chart. In this case, we are talking about, this is our current price level, right? So we are talking about all this price action. This is your left side of the chart. So always look left of the chart to identify original levels. Then draw a horizontal line and scroll the chart until you identify candlesticks which connects with your line. If that candle is part of another supply level you were looking at, then that supply level is not original. Never cut through candles. So you can see here, market has been in an uptrend, right? Strong uptrend. Time frame right now doesn't matter. This is an illustration. Then we get this bearish candle during the uptrend, right? This bearish candle becomes of importance. You need to be able to identify that now during live market data. Price has been rallying all the way up. Then you get a pause in the market. That bearish candle forms, right? Now look how price reacts on the next candle. It rapidly moves away. In that moment, when you notice this kind of price action, then you draw your horizontal line from your lowest point to the opening price. You see this rally here, that is of significance. So now an original level has been defined in the market. You see, you have to take note now that when price comes back down to this level, you are looking to enter into a trade. In which direction? In the continuation of the uptrend. So you are hoping that here there's gonna be a pause or a hesitation, or buyers will look to come into the market, whereby they will keep pushing the price up in the direction of the trend. The opposite applies for original supply zone. You can see this is an original demand zone. So the opposite applies. So it means market will be in a downtrend, right? Then you get a bullish candle that pushes price up. That bullish candle now is the one that you highlight when market continues moving to the downside, right? When it comes back here now, then you're looking to trade to the downside. So that's an original level. Now, how then to identify a fresh level? You look to the right to find fresh levels. You look to the right. Draw a horizontal line at the proximal line. I'm going to define more what is a proximal line later on, and take note if price has touched the level. if price is not pulled back to the line, then it's a fresh zone. Fresh zone is identified by looking to the right, and if you see that price has pulled back into the level or not, as you can see here, price has been in a downtrend. Then we had this strong push to the upside, and then price kept on rallying, right? Now, this reversal point in the market, this reversal point becomes of importance because you're looking to enter the market when price rallies back to the downside. You see, this level will hold when price comes here. So you're looking to trade long. You're looking to go to the upside because buyers here will look to hold price further. So that's a fresh level in the market. Now, so how then do you get to enter the trade? So now we are going to cover up how to validate a trade when price returns to a zone. Remember, you have identified your original level, you have identified your fresh zone. Now, the patience in you now is you must wait. You see, you wait for price to come back to those zones that you have identified. Now, how do you validate a trade when price returns to your level? The way in which price comes back to a zone determines whether the zone will hold or whether it's a good zone to trade from. If price forms a semicircle or a flag pattern when it retraces to a strong zone, the chances of a bounce will be very high, right? So conditions to take a trade will be much favorable. A sudden or instant return to a zone, on the other hand, price will mostly not hold. That zone is not going to hold. It will be blasted through. This zone is highly likely to be breached. My students know me when I say that zone has been violated. That's another case of a zone violation. So when you're looking at your zone now, when price is in your area, take note how it retraces back to that zone. If it retraces in a circular way, you see, a circular retrace to a zone is a much favorable validation for you to enter the trade in the continuation of the trend. And also a flag pattern retracement to a zone is a pattern also that gives you a favorable trade. You see, it's a favorable validation for you to enter into a trade, as you can see from the illustration on the charts here. Market to be in a downtrend, then you've got a flag pattern that retraces to the zone. You see the dotted line, that will be your zone. So when the price reaches your zone, you are selling in anticipation of market to continue with its trend direction. Now, on the other hand, now a sudden return, some people they call it a V return. A sudden return to a zone is not a favorable validation. When price rallies away from your zone, you'd have identified this area, right? And then suddenly it comes back into that zone. Don't enter this trade to the upside, right? And in the case of a bearish, you don't sell here, because this movement here, this V return to the zone, is not a good pattern to trade with. You see, so we've got two validation points that you need to perfect on. Remember guys, this is going to take practice for you to be able to identify this. And a secular return to a zone is not actually like a secular, you see. Remember, you're dealing with price, so it won't be like a real circle whereby I haven't said it should be a circle. No. You see that when I illustrate on a real market chart. So you must remember the V return, you don't trade that zone if price returns in a V return. So now let's look at when is a supply or a demand level confirmed as a zone. Now, a zone is validated under two main conditions. Number one, a supply zone or a demand zone takes out an opposing zone. Right. By this, I mean, let's say, let me grab my drawing tool here. A supply zone or a demand zone takes out an opposing zone. So let's say we've got market going up, then it creates demand here, then an original demand level here. So you'll be looking to trade high when it comes here, right? You're looking to go long. But if it comes back again to this zone, right, then you get price action like this, right? Then it continues in the downtrend. You see this candle here? That candle has already violated this zone. So you are no longer looking to go long. You now have a fresh zone that has been created, so that when market comes back here, you are looking to go short. So this is a supply zone that has taken out this demand and this demand, thereby a supply zone or a demand zone that takes out an opposing zone. Now, number two, a trend line connecting the last two peaks, which can either be swing high and swing low, has been broken with a full bodied candle consolidating away from it, right? Like on this illustration, take note of this strong bearish candle here. We've got this swing low, then we've got another low here, higher low, higher low. The two can be connected together with a trend line, which is our dotted line, right? So market is in an uptrend, right? So now you get this strong bearish candle. It takes out the trend line. You see, it takes out the trend line, then closes below. You see, that means the trend line connecting this low and this low has been broken by a full bodied candle. Remember, a full bodied candle. You must take note of the candle that breaks the trend line. So now this candle now becomes of significance. Say price comes back rallying into this area, then you're looking to go short. You're looking to short the market. Remember guys, we are now talking of the advanced concept here. This is whereby you are now looking to enter the trades. No more of the basics of supply and demand. This is now the stuff that you have to really understand. It's unfortunate not many people manage to come to the class because of work commitments, family commitments, but I'll try my best to explain everything here properly so that you all understand. So that's how you can confirm a level as a zone using those 2 points, whereby the first one is when either a supply or a demand zone takes out an opposing zone. So that means a supply zone can be taken out by a newly created demand zone. A demand zone can be taken out by a newly created supply zone. And then also a trend line connecting last two peaks, which is either swing high or swing low, has been broken by a full-bodied candle. Okay, let's move forward now. So I've just gone too ahead of myself there. How to draw supply and demand and what patterns to look out for. There are many candlestick patterns, so many it would take quite some time to learn them and even to remember them. You don't need to learn all of them to draw supply and demand, since only a few are of importance to identify and draw the basis of most supply and demand. In this section, we're going to focus on the following 2 candlestick patterns. Number 1, the engulfing pattern. We've already covered much of this pattern in our previous lessons. These are the bearish engulfing and the bullish engulfing. I'm sure you all know that by now. Then we've got the morning and the evening stars. We're going to talk about this further, but firstly, let's talk of the engulfing pattern. When a strong area of supply or a demand is engulfed, it often signifies a change in the market direction. The base that forms before the engulfing pattern often in most cases becomes the focal point that a trend changes its bias or direction. It represents a very high probability setup. In most cases, when a level is engulfed, price usually continues to the next level. As shown on the chart, you will find that this occurrence is common in the market. Right, so basically, the engulfing pattern, right? You can clearly see here, market was in an uptrend, right? It created demand, rallied away from the demand, right? Then 2 swing highs here and the swing low. Market breached that swing low, thereby creating a new supply zone, right? See here, this is a supply zone that has been created. Now, take note, when price rallies away from the supply zone, right? Price drops, but it closes lower than the lows of the demand. That means this level, this demand zone here, has been completely engulfed, right? Price has completely engulfed this demand zone. Now look how price returns. V returns to the zone. It rallies through, goes back to the supply zone. You see why the V return to a zone is not ideal to trade from? I'm sure you have seen why. Price rallies back to a supply zone. Now, this would be a fresh zone that would have been created in the market. Remember, fresh and original zone, that's a fresh zone. Now, price retraces to your fresh zone. What do? You look to go short. You see? You trade to the downside because this demand now has been violated. So you don't expect price to hold when it comes back into this demand area. So that's how you use an engulfing pattern. So it can either happen as a bearish engulfing pattern of a demand or bullish engulfing of a supply zone. Let's continue now. We're gonna focus on the morning star. Right. Morning star is mainly viewed as a bullish reversal pattern that usually occur at the bottom of a downtrend. Morning star pattern is comprised of 3 candles. A strong full-bodied bearish candle, which is then followed by a small bullish or a bearish doji, which is then followed by a strong full-bodied bullish candle to complete the pattern, as you can see on the chart there. In relation to institutional trading, we are going to be looking for the morning star around areas of strong demand, mainly on a higher time frame. The full-bodied bearish candle represents a lot of selling into the demand, followed by the doji, which in this case will indicate indecision in the market. The full-bodied bullish candle indicates buyers taking control of the market. Now let's see what it looks like on the chart. As you can see on the chart illustrated, we had price action on candlestick number 1, this guy here. There was a lot of selling into the demand area. You see, there was a lot of selling. Then you see the last bearish candle there, that's your bearish doji, candlestick number 2. Market was now undecided. You see, there was indecision in the market. There was no one really in control here, right? This is a daily candle on the NZUSD. The moment you see a daily candle close like that, there's no more selling pressure. Then the following day, you get a full-bodied candle to the upside, a bullish candle, right? There's your signal now. Buyers looking to take control of the market, right? Full body bullish candle. So 1, 2, and 3 candlesticks. Very important. The moment you highlight, say, your demand zone on a higher time frame. Now, come to number 4, candlestick number 4. What are you going to be doing during that day? Are you going to be looking for short? No. You are looking for long trades. You get it, guys? You'll be looking for long trades during this day. There's no need for you to be looking for shorts there. That's suicidal. You can't do that because already market has given you a signal to say, no, this demand zone has hold. The buyers here are in control of the market. Thereby, you have to capitalize on that by going long. You only look for long trades. There's no need to be looking for shorts. As you can see, the following day, market was rallying to the upside. You see, guys, that's all you need to do. Excuse me. That's all that there is to do with a morning star pattern. So I urge you to always try to practice this on a higher time frame so that you see how it actually plays out. We recently had a morning star on the Euro USD, if I'm not mistaken, but that's for your homework now. You need to go to the Euro USD chart, then look at Tuesday, Wednesday, and Thursday, those 3 days of this first week of September. So now this is a morning star. Remember, it's viewed as a bullish reversal pattern. So you only look for morning star when you have a strong demand area that you are expecting market to reverse from. So now the opposite applies now. Morning star, then we've got evening star. The evening star, on the other hand, is a bearish reversal pattern which usually occurs at the top of an uptrend. Likewise, it also comprises of 3 candles. Number 1, a strong bullish candle indicating, what does it indicate? It indicates more buying into a supply, followed by a small bullish or a bearish candle. What does that one signify? If you look on the chart, that's number 2. It indicates indecision when price is in a strong area of supply. And then you get a large bearish candle. What does this one signify now? Number 3. Number 3 signifies sellers coming into the market, sellers looking to take control of the market. So that will be number 3. So that's what's illustrated right now on the chart. You get number 1 here, strong buying into the supply zone, right? Then you get number 2, a bullish doji, which can also be a bearish doji. So now the significance here now is it's happening on a strong area of supply. So number 2 can also either be like this candle here, or this candle here, or this candle here, right? That would be number 2. But the reason why these 3 that I've highlighted now, you can see there was no strong buying into the zone. It's either there was no strong buying or there was no strong selling. You see, there was no strong selling into out of the supply zone. So remember, an evening star is the opposite of the morning star. So in a nutshell, these 2 patterns, the engulfing pattern and the morning or evening star pattern, is very important. You should be in a position to identify this on a higher time frame so that you capitalize. When you go to lower time frame, you should be in a position to capitalize on that, so that you don't enter trades where you are not sure. You enter trades that are going to give you a better chance of a good trade, right? Trades that will either be positive, or at least you're not going to be scratching your head when the trade is in a negative state. So that's much about it on evening star, morning star, and engulfing patterns. So you must be in a position to identify these 2 aspects on supply and demand zones. So now let's branch out a bit and talk about what I call proximal and distal lines, right? Remember, those 2 lines you always use when you're drawing your supply and demand zones. Those 2 lines are very important, guys. It's not just a case of say, oh, Ivan, he said, okay, supply zone, higher high, the highest point, the highest price level that has been reached, and the closing price of that bearish candle. Or if it's on a demand, the lowest point price is reached and the closing price of that bullish candle, right? I draw my lines there. Those 2 lines, they are very important. The base of any supply and demand is defined by a proximal line. this is your lower line, and a distal line, which is your upper line. The distal line will be the price further away from the current market price. For example, we've got a demand zone here, right? You can see my two dotted lines. The distal line will be the price further away from the current market price. The distal line will be the price further away from the current market price. You see where my distal line is? This line here. There's my price. That's my current price of gold. This is a gold chart, guys. Now, the proximal lines are always at the top on demand levels. This is a demand level. So the line on top, this is your proximal line. The opposite applies for supply levels. So if it's a supply level, they are the ones at the bottom. The opposite applies for distal lines. When drawing supply, always cover the highest high in the base area or the peak, which is the swing high. When drawing demand, always cover the lowest lows in the area, which is your swing low. This is of huge importance. It's paramount that you master this. For instance, right now, we would have identified this candle here would have signified that this area is a strong area of demand, right? But now, if you take note, I didn't start drawing my demand line from there. I started from the lowest low, right? Which is my swing low. Price swinged there, right? And then I took my proximal line, the support of the candle that broke out. You see, all the highs which have been broken by this candle, that's where my distal lines starts at. Remember, this becomes sort of an art. It's not like Paula when she draws her supply zone, or Kaya when she draws her demand zone, or Mojalefa when he draws his supply zone. We are all gonna draw the same. This is gonna be specific to you as a person. You'll be identifying the zones you are looking to trade from, but always try to be nearest to the same levels that I've highlighted. So they're not gonna be the same, but they should be close, right? So that's how you draw your demand level. So the upper line on your demand level, that's your proximal line. The lower line, that's your distal line. So now this is an illustration of proximal and distal line on a demand level. Now let's see on a supply level what that looks like. So we've got price swing high. It formed a swing high here, right? Price formed a swing high, then rallied away from. So you can clearly see that this is a strong area of supply, right? And it's a fresh supply zone. So now the opposite now applies. The lower line on a supply level, that's your proximal line, and the upper line, that's your distal line. You see, the line further away from the current price action. Look where my price is, and look where my distal line is. So this distance defines a distal line. You see, so this is an illustration of proximal and distal lines on a supply level. What I've just explained in the past two slides is going to be of importance when we talk of dealer spikes, stop hands. You see how institutional traders create their liquidity, because those lines there, they are going to be breached at some point, and the way price closes will be of importance. So now let's look at dealer spikes. Let's talk of stop hands, which is the most terminology that is used by traders out there. Stop hands. Excuse me guys, I have to take a sip of a drink, otherwise I'm gonna be dry in the mouth. When price tests a fresh zone, the probability of a successful trade away from the zone is very high. And remember, we mentioned this when we talked of the original and the fresh zone. The first test always offers the best and highest probability trades. When price pulls back into a zone for the second time, right? The second time, remember, used up non-fresh. That's a non-fresh zone, not a used up. Used up is 4, 5 couple of times. When price pulls back into a zone for a second time, that's when we have to consider the conditions of dealer spikes, right? Price is pulled back into your fresh zone for the first time, there is a good probability setup. Then for the second time now, you need to put into consideration stop hands. The spike breaks price swings. It can either be a low or high, but does not hold. It gives us a clear picture in regards to what price action will do and which market direction buyers to take. Institutional traders in most cases will try to take out retail traders' stops, right? Stop hunting, guys. You know this. This is called engineering liquidity. That's from an institutional point of view. It's called engineering liquidity. Some call it stop hunt. Whichever way you prefer to call it, they all mean the same. Have you ever been in a trade where your stop loss is hit, but then the market proceeds to go in your chosen direction, yet you are already out of that trade? To understand this, you need to first learn how institutional traders operate in the market. Right. For institutional traders to enter the market, they need liquidity. They need your money, guys, to fill their orders. Ironically, the liquidity is provided by you, the retail trader. A retail trader's mindset must fall if you are to succeed. So, how then do institutional traders get the liquidity? Okay, before we proceed to that, this is an illustration of a stop hunt. This is a dealer spike illustration. This is a Euro USD H1 time frame, right? We've got an original level here, a fresh level that has been created in the market. Remember, market is in a downtrend. There was this pause here, then market dropped. You see the secular move I was talking about? You see the secular move? Can you see it there? You see here? There. That's what it looks like with candlesticks. Now, first test, boom, good trade. First test of the zone, you short, great, good result. You harvest your pips, right? Now, second test, there we go, secular, return to a zone, right? Now, look at this green candle here, right? Look at this green candle. It rallies up. At one point, it's a complete huge green candle. Now tell me how many retail traders are going to be selling there? Not most of them, right? Not even 90%. 90% will be buying. Remember that green candle that I've highlighted? This guy. At one point in time, it's a complete green candle without this wick. Retail traders, they're not going to be selling there, guys. They will be buying. Market is now going up, right? We've all been there. We all know this. Now, it's important, like I always tell my students, wait for the candle to close. Wait for price action to close the current time frame. Now, look what price did. It spiked into our supply zone towards the close. Price rallied down, closed below our supply zone. Remember, proximal and distal lines. This candle closed just by mere looking. You see, this was our highest point, right? Then we've got our distal, we've got our proximal line. We've got our proximal line there. Let me do this perfectly. Why am I doing like amateurish? There we go. All right, there's our distal line. You can see that green candle I've been mentioning, the bullish fully bodied candle, closed below your proximal line. There is your trigger. That's your trigger to sell, right? Buy orders and sell stops will be stacked here. Most people, they will have their stop losses in this area here. Breakout traders will buy here in the anticipation that, okay, this level has been breached. Market is going to keep going to the upside, right? Breakout traders are going to buy that. And people who have sold probably this high, right? Or even here, right? People who would have sold, they would have put their stop losses here, 5-10 pips above this high, also triggered. There is the liquidity now. You see, the institutional traders, they've got what they require. Now, what's next after that? Market tumbles. Now they crash the market. Institutional traders, now they're selling now. They sell into retail traders' buys, thereby providing the liquidity for the institutional traders to push the price all the way down, which is exactly what happened here. Remember, guys, I always mention, you buy when they're selling, you sell when they're buying. You see, a retail mindset must fall. If you are to succeed long-term wise, I'm not talking about robots, indicators, or whatsoever. Yes, you get robots that are going to make you money in a short term, but if you are going to be in this for the foreseeable future, you need to be able to read this type of structures. See, you need to be able to see what I'm talking about here. So now let's talk about how then do institutional traders engineer liquidity. How do they get liquidity from the market? So the basics of supply and demand, right, states that for every seller there has to be a buyer. Same applies for every buyer, there has to be a seller. Someone else, guys, has to fill your order from the opposite direction. When you're selling, someone has to buy. When you're buying, it means someone is selling, right? So this is the scenario which comes up now, right? So for institutional traders, for them to buy or to enter long positions, what do they need? They require most retail traders to be selling. They require short liquidity, right? So for institutional traders to be selling or to go short in the market, to open short positions, what do they require? They require long liquidity. They require people to be buying, right? You see, they entice the market to buy, yet in other words, they want to sell, right? So from an institutional point of view, for them to trade long, they're going to require short. They're going to require shorts. They require people to be selling, right? For them to trade short, they require longs. They need retail traders to be buying into the market, right? So what's the solution then for these institutional traders? What then do they do? So how do they create short sellers when they want to trade long? They engineer long liquidity, right? And how do they create long buyers when they want to trade short? They engineer short liquidity, right? How then do they do this, right? There's what we call liquidity pools. These are areas of interest. These are areas where there is likely to be a lot of stop losses, and then limit orders. Either buy limit orders, sell limit orders. You see, a limit order, whether it's pending, right? This is raw or untapped liquidity. It's money which is there, which is triggered or released by a price rally through a certain area, right? From an institutional point of view, if price rallies through price X, sell orders will be triggered, thereby creating long liquidity. If price rallies through price X, buy orders will be triggered, thereby creating short liquidity. Let me illustrate this a bit, right? I need my pen too. Right. Sell orders will be triggered. That's creating long liquidity, right? We've got price here, right? So price has been rallying, it bounce, rally, it bounce, then price is, say, right there where I've ended here, right? So what do you think most people would do or anticipate when price is here, right? So that means we've got people who have sold here, right? They have sold, they've got their stop losses above this level. No, price is not gonna reach there, right? Then that's for people who have sold. Then you've got breakout traders, people who are anticipating this level to be broken and then market rally, right? They've got their limit orders here, right? They've got their buy limit orders stacked up here, right? Already there. You see, the orders are already there and they're just pending, right? So that means we've got two types of orders here. We've got stops, which are stop losses. Then we've got limit orders for people anticipating price to rally up. Now, what does price do, right? Price is gonna move. Price is gonna come. It's gonna come. Rallies up, right? What is that done, right? Stop losses have been hit. People are already out of their positions, right? The buy limit orders have been triggered. They are smiling. Market is now in. I'm in the market now. Price is gonna rally. Then what does it do? Comes back down. You see how they've created liquidity there. This is an illustration of short liquidity. They are engineering short liquidity here. Price is gonna rally. So this is X. This is where most people will have their stops, their buy limit orders there. Price will rally through, triggering those stops, triggering those limit orders, the buy limit orders, instantly rallies back down. Now, what do you think the market is gonna do after that? It's never gonna look back at this zone. It's gonna crash to the downside. You see, the same applies for long liquidity, right? You've got price coming up and down, right? Coming up. Now when price is here, right, people would have bought here, right? People are in a long positions, their stop losses are down here. Then you've got breakout traders who are anticipating this level not to hold anymore. They've got their sell limit orders here. So this is X, right? So what does price do? Rallies through, triggers all those stops and the limit orders, right? Once that is triggered, the sell limit orders, they are smiling. Our market is now flashing to the downside. What does the market do? Instantly comes back and it rallies without even looking back. So that's how it looks like from an institutional point of view. So this rally into this price area, which is X, creates the long liquidity for the institutional traders to buy into this asset. Say for instance, this is gold, right? When the price rallies here, and then they take it to the upside, right? So price X represents a liquidity pool. This is an area of interest for the big guys, because most retail traders, that's where they put their stops, guys. That's where they put their limit orders. So you must always know X is not a good area to play with. Wait for your candlestick to close before you get in. So X represents a liquidity pool where the stops will be resting, right? So we all know where most of us retail traders put our stops, right? The following areas are most likely to be the source of liquidity: below range highs, above range highs, below swing lows, above swing highs. So the moment you see price playing around those four areas that I've mentioned, range high, swing lows and swing highs, the moment you see, wait for the market or the price action to close. You need to wait. Don't rush to get into that trade. Wait, because there's something that will be going on that you will be able to recognize, say after your daily candle is closed, if you're trading from a daily time frame, or after your hourly candle has closed, if you're trading from an hourly candle. So you must be in a position to wait, right? So now we are going to talk about some mistakes that traders do make when they are trading with supply and demand, looking at liquidity pools. So there's common mistakes which most traders do, is assuming that every high or below every low there's a liquidity pool, right? That is not correct. It's wrong to assume this. So not every swing high or swing low, not every range high or range low is a liquidity pool. Now, you need to try and focus on the following to filter out probable liquidity areas. Most likely areas where retail traders put their stops. You see? support and resistance, above a support, above a resistance. Avoid those areas. Higher time frame, high lows, highs and lows, most notably D1, weekly and monthly. You see those highs, those are the ones you need to wait for price to close first before you can take any action. Extended consolidation ranges. Buy or sell limit orders will be resting on both sides for those who are anticipating to enter the range breakout. Swing points, notably on high time frames, work much better because almost every trader will recognize them. This in turn means a lot of orders are placed below or above them, right? Personally, I use swing points on a weekly chart, daily chart, and H4 chart. That means I wait. The moment I see a swing point, whether it's a low or a high, being tested, say on an H4 time frame, I wait for that price action to close. I wait for that H4 candle to close before I can make a decision. Equal highs and equal lows also provides areas of liquidity for the institutional trader. Okay, let's go to the next slide. Stop hunting or market maker profiling. By now, most of you guys know how to identify liquidity areas. Remember the areas I've just mentioned on the previous slide, and also what is the purpose for liquidity. You see, why the institutions require liquidity. Let's take a look at dealer spikes, stop hunting. What is stop hunting? This is when price trades through an area where most retail traders assign their stops before rallying in the opposite direction, right? Definition of stops. In regards to a bearish example, I've already illustrated this, guys. This is when market takes out high or breaks resistance before rallying lower. I've already illustrated this a while ago. Let me just illustrate it a bit. Sorry. Let me just illustrate a bit so that you can see what I'm talking about. We've got our resistance there, right? So in a bearish example, this is when market takes out a high, right? Remember, we've got price, and then market takes out those two previous highs, right? Then instantly market crashes, right? That's a bearish example of a stop hunt. This would then create buyers, and when buyers are created, that's short liquidity. Remember that rally that breaks the high or the resistance before running lower, that breakout in the structure, that creates short liquidity because stop losses and limit orders have been triggered, right? Same applies for bullish. Let me illustrate for bullish quickly. Where's my line 2? My line 2. We've got our support there, right? We've got our support. Then we get price. It's not perfect. We've got price. Come, swing low formed. Another swing low formed. And then price rallies through, right? And breaks the low and breaks support before rallying back and continue with the uptrend. So this is a bullish example. So all the stops down here, the limit orders here, remember this is X, a liquidity pool area of interest. You see, so when market rallies through, closes above, all the way to the moon, that's the bullish scenario. You see, there's a stop. Stop loss is for those who are short. When price rallies through this, they turn into market orders to buy. Remember, we're talking of a bearish example. So now you are selling. You've got your stop loss above your entry point. What do you think that stop loss turns out to be when it gets hit? It turns out into a buy order, right? Someone is buying on that stop loss. And who's that someone? An institutional trader. Limit orders of those who are anticipating to go long. When price rally through this, they turn into market orders to buy. Remember, we're talking of a bearish example. When price rallies through X, there's limit orders for people who are anticipating the price to keep going up. Yet, in other words, market wants to go all the way to the downside. So what's achieved, right? Buy orders are going to flood the market, right? Buy orders, which means longs, right? And when longs flood the market, what does that provide to the institutional trader? Short liquidity. Institutional traders then pair their shorts with retail buys and take the market tumbling to the downside. Simple, basic stuff. You have to understand this. The relationship between stop hunting and liquidity pools should be clear to you now. Most retail traders' stops are the ones that create the liquidity. They all tend to be concentrated in certain areas which we have covered before. We need to think like institutional traders, guys. If we are to hop on the same bus with them, we need to define where to get the liquidity. When we want to trade short, we need to define or locate where price needs to go to create buyers, to trigger buy stops, because buyers in turn create short liquidity. You see, when we want to trade long, we need to define or locate where price needs to go to create sellers, to trigger sell stops, because sellers in turn create long liquidity. You see, so that we trade along the institutions, we trade along the big guys. Most times, this is the reason why market price will take out a high before tumbling down in the opposite direction, or take out a low before rocketing upwards. You see, this is the mentality that I'm trying to instill in you guys. You see, so that you can progress. So how to differentiate a real breakout and a stop hunt? Simply, this is quite difficult, guys. That is why most times stop hunting works well against retail traders. That's why most retail traders, they don't make money, because stop hunt is a well-oiled machine. You see, it works. But there are certain criteria that we can apply to avoid getting caught up in a stop hunt, right? You need to take note of what price is doing. Monitor price action on your time frame. Higher time frame is of importance. If a price rally is a stop hunt, price normally react when highs or lows are taken out. Wicks which are tall, absence of momentum, these are the signs that you need to be looking out for, as you're gonna see on the following charts now, where I'm gonna illustrate all this. Try to avoid putting your stops, these are the limit orders and stop losses, at areas which are obvious liquidity target areas. You see, always try to avoid those. Full high time frame candles close above or below critical levels. You need to take note of this. Divergence can also help, but take note which divergence it is, whether it's bullish or bearish. whether it's hidden bullish or hidden bearish divergence. We're going to talk about divergence a little later in the course, right? So now let me illustrate on a chart how long liquidity is engineered, right? We've got here the Japanese index, the nickel index, Japanese 225, whatever you can call it. So here you can clearly see how long liquidity has been engineered, right? This is a 15-minute time frame. This is for illustration purposes. You can see market has been rallying. You see that zone there? Can you see that zone there? I talked about this right on the first section of this tutorial. There is your original zone. Market makes a circular return to the zone. What does it do? It rallies up. There is your first test of a zone, successful trade, right? Market makes another return to the same zone. But now look at the price action which is happening there, guys. Look at the price action. There's a spike into the demand. Takes out this low, takes out this low. Most people would have been selling here. This candle at one point is a big bearish candle. Most people were selling there, right? But us people with an institutional trader's mindset, wait for the candle close. Moment you see that candle closing, you are already buying. You are opening your buy positions, right? Where's your stop loss? 10-15 pips below this low. See here, this is where your stop loss is at, right? Now what happens next? Market shoots to the moon, right? It comes back down, ranges, and then eventually sky rocketed. By the time this price action happens, this stop loss is already above your entry. Now tell me this is not a good trade. There will be definitely something wrong with you. So prior to this screen grab, you can also see there another stop hand going on, but obviously this candle had not closed, so I wouldn't really know what happened after. So now let me illustrate how short liquidity is engineered. Right, we've got Euro AUD here, H1 time frame. Euro AUD, H1 time frame. We've got price rally, creates a swing high here, right? A fresh zone has been created. There was a small retest and a good trade to the downside. You see, this is a good short trade of this supply zone here. But now look what happens next, the second time it tested the same level. You see this candle here, this bullish candle here. At one point, it's a green candle from here all the way up there. Remember, it's an H1 candle. Now, how many people were buying there? Most retail traders, I'm telling you, they would have been buying. Most breakout traders would have been buying, right? But now, you wait for the candle close. Closes below proximal line. Remember, the proximal line, distal line. Price closes below the proximal line. What do? You sell. There you go. You're selling. Same thing happens with this candle here. Rally through X, liquidity created, sell. Look at this other test. It didn't even go close to this high. Then market crashed. That's how short liquidity is engineered, right? Now let's look at how that looks like now. A stop hand into a demand or a supply level. Now that we have understood dealer spikes and how liquidity is engineered, I'm going to illustrate how you can combine the spike together with supply and demand to have high probability trade setups. Price often comes back to test a zone for a second time, taking out stops for traders who were not well below a demand or well above a supply. Price can also come back to collect or trigger buy or sell orders. These also provide liquidity. When this has happened, or when we have managed to identify that spike, we can use this analysis to make entries as soon as price move above proximal line if it's on a demand, or below the proximal line if it's a supply. Right, so this illustration below shows a dealer spike into a supply zone. The opposite applies for demand, guys. So we've got a supply zone here, right? Remember, we've got our swing high, bearish candles close, we draw our proximal line. So this is our proximal, this is our distal line, right? Now, first test of the level, always successful. First test, market close below the distal line, we are selling. Second close now, second test into the demand and takes out stops. You see these highs, how this high has taken them out, and then close below, then you're selling. Now you wait secular return to the demand there. This price action is never going to be violated if this level is a strong level. So the moment you see a spike into a demand close below your proximal line, there is your entry. You see, there is your entry. There is your perfect trade to the downside. You see, guys, patience is a virtue. Wait for the trades that you are going to be successful in. Yes, market is random, market is manipulated at some point in time, but there is criteria that we can use that will grow your equity exponentially. You see, your equity will always be growing. Yes, there's gonna be losses, but there's gonna be minimized losses. So the same applies for a demand, guys. So there'll be a first test of that demand, then a second test which has got a stop hand spike into the demand, then price rallies away from the demand, meaning long trades. Right, now the following is something that I've come up with, and I've been meaning to give out this to both the groups, the advanced group and the guys who are just beginning with me now. So I'm sure this is the right time. Everyone now has got an idea. This is a more detailed explanation of the proximal and the distal lines. So this is what we call the supply and demand range. Excuse me, guys, just a minute. I was just taking a sip of my Mazoe Orange Crush, all the way from Zimbabwe, guys, all the way from Zim. It's unfortunate the old man has passed on, but life goes on. He must rest in peace. So the supply and demand range, guys, assessing when a trend has changed is one of the hardest things a trader will face. Let's be honest, guys. We also struggle with this in the group, but when we get it right, we get it right. The reason being that every time frame has its own trend, and multiple trends coexist in time frames. You may be trading in a downtrend on H1, but when you look at D1, it will be an uptrend, and on a weekly chart, it will be a downtrend. You need to define the time frames you will be using in your analysis properly, and stick to that. Do not switch randomly. Always stick to the same, right? You must choose an entry time frame where you will be highlighting your entry supply and demand levels. After that, define the time frame to analyze how high or how low you are in that range. This will tell you if you are too high to buy or you are too low to sell, right? If you are too high in the range, you should be thinking of exiting any long positions that you are holding and start looking for supply zones to lean on for short opportunities if the probability is high enough for short. I have designed a criteria that can guide you in observing how high or low you are in the range. Decide the percentage that you consider as too low in the range, as in how close you are to the lower proximal line, and don't go short if price is lower than that percentage. Do the same for the high percentage. Stick to these criteria and don't break the rules. You will avoid many losses by doing so. So basically, this is what I'm talking about, right? Trading high or low in a supply or a demand, in a supply and demand range, right? I've got an illustration with a weekly time frame, right? The green zone, that's my demand zone. This red zone, that's my supply zone, right? So, say for instance, I have defined the zone between the supply and demand having 500 pips, right? I have defined that range. Okay, there's 500 pips from the demand to the next strong supply level, right? So now, remember, you've got your proximal lines here. On demand, that's the upper line. On supply, that's the lower line. These are your distal lines, right? So 500 pips in between, halfway in between, that's your 50% range, the middle range of your supply and demand zones, right? So that's 250. From here to the demand, we have 250. From here to the supply, we have 250. But now, from the middle line to 35% or lower, you see, those are the areas that I'm saying you need to define now for yourself. You need to define what's the best percentage of your zone that you say, okay, no, if price is 90% or higher, yeah, this is where I'm going to be playing at. Or if price is 20% or lower, right? For me, if price is 85% or higher from the middle line, from the 250 pip range, right, I do not open any long positions, meaning this area. This is an area close to my proximal line of the supply. I don't look to open any long positions because it's too risky. This is an area whereby you are looking to lock in your longs, meaning to take profit or to close the current long positions that you are in and start thinking of exiting those positions, right? and start looking for levels of supply on lower time frame to go short. And on the other hand, if price is 35% or lower to the demand proximal line, right? That means we are talking of this area here. This area here. I do not open any short positions. I look to lock in my shorts and think of exiting those positions, right? So I'll be looking for demand zones on lower time frames for me to start looking for long positions, right? So you can clearly see, guys, this chart is self-explanatory, right? You are on a weekly chart. You define your supply and your demand zone. How far are we from the supply? How far are we from the demand for you to go short? How far are you from the supply zone for you to go long? So this chart, try to print it and stick it somewhere, whether in your office or home office or your bedroom or wherever, so that you understand it, right? You see, so that you understand it. 500 pips between the two zones, the supply and the demand zone, right? Say for instance, price is hitting close to 400 pip from demand. Then you still want to go long. No, that's not right. That's suicidal. Yes, at some point you can go in and then market keeps rallying all the way up. But now remember, we are looking at it from a point whereby the supply zone is gonna hold, right? Now, if say price is almost 480 pips away from the supply zone, then you still want to be selling. No, that's not right. That is very risky. That's why most people lose. That's why retail traders don't make money. The moment you have already seen, okay, no, but I'm already 400 pips away from my supply zone, and the distance between your supply zone and your demand zone is 500 pips, then why should you be selling? You see, you should start looking for strong demand zones on lower time frames there for you to go to the upside. You see, it's that simple, guys. So now let's talk about trade configurations. Most people are always asking me, which time frame should I trade from? What's the best time frame to trade from? My answer to this, guys, is it's all about you as a trader. Which time frame are you comfortable with? For me, higher time frames, H4, daily, weekly time frame, and H1 entries. So trade configuration, top-down analysis. If you are swing trading, this is the configuration that I advise people to use. This is the best time frame combination for medium-term trade setups. Your higher time frame bias will be based on a weekly chart as your supply and demand range and directional bias. Your intermediate range is on the daily chart as your intermediate supply and demand range and trade bias. Your execution is going to be on the H4, right? That means your entry points are going to be based on the H4 time frame. Then we've got intraday trading configuration. This is the time frame combination for short-term intraday setups, right? Higher time frame bias on this configuration will be based on the daily chart. This is where your supply and demand range and bias will be based on. Your intermediate range is going to be on the H4 chart as your intermediate supply and demand range and trade directional bias. Your execution is going to be on an H1 chart. So this is where your entry points will be based on. So that means you need to be waiting for the H1 time frame to close, right? Then we've got position trading configurations. If you choose to focus on daily supply and demand zones as your entry time frame, you need to use this longer term combination. Higher time frame monthly chart as your supply and demand range and directional bias. Intermediate range weekly chart as your intermediate direction and part of your top-down analysis. Execution and trade management will be done on a daily time frame. You see, so this is whereby if you open a trade on a daily time frame, right, your stop loss is also going to be based on a daily time frame. This really does help for people that do not have time, people that have got other commitments in life, people that have got a 9 to 5 whereby they're not going to be able to look at the chart when they're at work. So this configuration is the best, the position trading configuration and the swing trading configuration. Because what this means is, say you open a position on your daily time frame, right? So it means you wait for market close according to our GMT, that's 11 p.m. When market closes 11 p.m, you see how that daily candle has closed. Then you open your position, you close your PC, you go to bed, you sleep, go to work tomorrow morning, later again during that same day towards 11. Then you look at how your trade is going. You see, that's the benefits of position trading and swing trading configuration. So yeah, these are the configurations that I advise most people to use. Yes, most people, they want to trade short time frame, 15 minute, 5 minute, but that's not going to be sustainable, guys. Let's be honest with each other. That's not going to be sustainable, right? So let's move forward. How to define a trend using supply and demand. Firstly, an uptrend. Demand zones are being respected and supply zones are being eliminated from the market structure. Remember the engulfing and the morning star? A higher high should remove previous supply in order to validate the demand zone. Always ask yourself whether the preceding supply has been eliminated. Let me illustrate this quickly. Let me grab my pen here. Let me illustrate this for you guys. Okay. Right. Always ask yourself whether the preceding supply has been eliminated, right? So for instance, let's say, sorry. Okay, I've got my pen too there, right? Then price rallies away, comes back, rallies away, right? So that means this is a strong supply level. But now, if market comes and breaks this and rallies away, this level has been eliminated, right? Because price never looked back. So it comes back again, then rallies away. You see this level has been violated. Comes back, same process repeats. You see, that's a definition of your uptrend. Lower high, higher high. You see, higher high as we move on, right? So that's how you define and trend using supply and demand. So it means this supply level has already been violated here, then market creates another high, it comes back to that supply, then continues with the uptrend. The same applies in a downtrend. Supply zones are being respected, right? And demand zones are being eliminated. A lower low should remove previous demand to validate supply zone. Ask yourself whether the previous demand has been removed, right? It's that simple. Ask yourself, right? Let me illustrate this quickly. Price is rallying down, comes back up, rallies down, comes back up, rallies down. You can see how this low was taken out here. Price never looked back, but when it came back, it gave us an opportunity to trade short again. Comes back, rallies down. See how this one was taken out here. Price never looked back. There's your definition of a downtrend using supply zones, right? Ask yourself this: what type of trading are we dealing with here? Are you trading the correct supply or demand that you see on the chart? Always aim to trade to those areas where the institutional traders leave a mark or sign, where smart money is looking to add more positions. Analyze daily and weekly charts and see what is going on with the supply and demand zones and decide which direction to trade. Once you know the bias that you want to trade along with, define lower time frame supply and demand zones. Those areas with strong impulsive departures in less time from a zone, which are fresh zones. Always plan your trade with a result of 3-to-1 risk on 3-to-1 return on your investment, right? There are factors that you have to consider when choosing supply and demand zones. Don't worry guys, we are almost done, just 2 more slides to go. So these are the factors that you have to consider when choosing supply and demand zone. What has the zone achieved, right? By this I mean, the buyers, have they achieved what they need to do? The sellers, have they achieved what they need to do, right? What is the strength of the move? You see the impulsive move, does it have strength in it, right? Is the candle big bodied? You see, what is the risk reward ratio? You see, you need to consider all this. The location of the supply and demand, where is it located in relation to my bias? Where is it located in relation to your trade configuration? You see, on a higher time frame, where is your supply and demand located? The quality of the base is also important. Confluency. Dollar, for example. If dollar is at a higher time frame supply and the euro is at a higher time frame demand, we have to go long, nothing else other than that, right? These are some of the factors to consider and should be taken into account when you choose a zone to trade from, right? So my advice for you guys, less is more, right? How can we achieve consistent profitability trading in Forex? The moment you accept that you are not in control of the market, your ego needs to be in check, then you have taken a huge steps. The markets do not care about you. It has no emotion and it's not a living entity. The Forex market is an industry where people express their belief about the exchange rate of certain assets. Retail traders tend to overcomplicate their analysis, and the professionals can take advantage of that. In Forex trading, the money flows from the people who don't know what they are doing to those who know what they are doing. Spending less time analyzing the market, trying to find the perfect trade will actually make you progress much better and make more money faster because you are relaxed and less emotional, which in turn will help you not to overtrade or over leverage your trading account. This is why I recommend swing trading and using H4 chart. This will help you in improving your results and enjoy your life more. There's more to life than trading, guys. Don't be an MT4 zombie. Right, so to summarize what we covered today, I know it's quite long. It's going for almost 1 hour 40 minutes now. Like I said, this video is gonna be quite long. To summarize and conclude, by now you should be able to understand the following, right? You should be able to highlight a dealer spike, or in other words, a stop hunt. You should be able to understand and identify fresh and original zones. You should be able to draw your supply and demand zones. Understand how liquidity is engineered. Understand the engulfing pattern. Understand the morning and the evening star. Understand the supply and demand range. Remember that chart I said you must print out and stick it somewhere. You must understand that chart. You should be able to understand your preferred trade configuration. This all comes down to you as a person, guys, which trade configuration is gonna suit your time. It's gonna suit your lifestyle. You see, you should be able to define a trend using supply and demand. So basically that is pretty much about it, guys. So we covered quite a lot in this tutorial, in this video, and I do expect a lot of people to come up with questions and bring them on, guys. Do not hesitate to comment. I advise people to comment on the video, guys. Just comment below and then I'll get back to you. And if you are in the group, you know what to do. If you have any questions or a certain part that you have not understood, we are going to be having quite a few Zoom sessions regarding what we covered in this video. So take your time. Weekend is upon us. You've got a lot of time. I know most people are at work and all that, but you should have at least some time to watch the tutorial. And for those who are new to my tutorial, guys, just click the subscription button below and make sure the bell icon is ticked so that each and every time I post a video, you get it delivered to your mailbox instantly. And subscribe to the channel, guys, and share with your friends. We are all about educating people here. Yes, there's a lot in Forex at the moment, a lot that's going on, but I'm really trying to show those who have joined my mentorship group the right way to do this. So yes, it might take a bit of time, but trust me, once you are done, once you know all the ins and outs of what I'm teaching, you won't even need me to be around, which is the main goal. You should be in a position to trade by yourself at your house, at your workplace, or wherever you are. You should be in a position to be trading, open a chart, read the market structure, and see exactly what price is telling you. Anyway, enough chit chatting. Make sure you subscribe to the channel, guys. Comment below with any suggestions, comments, queries, or things you want me to add on, so that we can move way much better together. So yeah, if you haven't joined my mentorship group, just inbox me or get in touch with me on the numbers below to join my mentorship. Thank you, guys, and have yourself a lovely day. Goodbye for now.